This is our Forex plot for March 9th, 2012. Like most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. We compare every currency to every other one on multiple time frames. The histogram on the top measures the intensity on a real-time bar-by-bar basis. It's composed of 5 different statistical trend tools we've developed over the last 6 years. 3 of them measure the direction, in this case that the dollar is moving versus all the rest, and 2 of the 5 measure the intensity. One's a bar-by-bar intensity compared to the last 20 days average for this time of the day, and the other one's a 30 to 45 minute intermediate time frame trend. We average those all together into one very smooth and easy to read indicator. And when you see a currency like the dollar have incredible strength like this at and above the dotted white line 80 level, and then during the pullback phase, because markets rarely go up more than 2-3 hours at a time without some kind of a pullback, it might be, or a sideways move. It might be 15 minutes to 30 minutes, or hour, hour and a half, sometimes 2 hours. But usually, whenever you see extreme strength like this, followed by the counter trend move having 1/2 to 1/3 the momentum of the previous move, this is the dominant direction, and that trend's very likely to continue, which it does. And you can see for an hour, from 2:15 or so to 3:15, it's strong again. So you want to find the exact opposite pattern on a weak one. And by the way, underneath that we had a daily trend, weekly trend, a monthly trend. Ideally, I focus mostly on the weekly trend. If the weekly trend's up and I see some strength, then I'm more apt to take that trade. So let's scroll these charts back a little bit. 1 second. So I'll push a button on here so that they all scroll back at the same time. So you can see the euro was mildly weak coming up to midnight. So was the pound. Pretty much as well as the yen. The yen was actually one of the weakest ones, and the daily, weekly, monthly trends down. But at this point right here, the dollar had strength, so did the yen. A lot of times the dollar and the yen move, kind of in the same direction at the same time, and you're likely to have a choppy direction. That's why I don't personally trade the dollar yen too much. So let's look back down here. The euro was weak, and the pound too. We'll compare the two. So you're looking to sell the euro dollar coming up to right around the 2 o'clock area. You're looking for this pullback to end. It's likely to continue to be strong, and so we're going to look to sell the euro dollar after 2. Hit the plus key to zoom in on this, and you can see this trend started to go down. This one has the added benefit of seeing that the major areas of support resistance. Our Fibonacci analysis each night shows that this is a Fibonacci area, it's a support area, and it was holding support all night, and then it got broken. So anytime a support area gets broken, it then becomes resistance. And coming up to 2 o'clock right here, you have this nice little trade right here, short at 34, came all the way down to 14. So it did fall 20 pips. If you used our lower containment bands, or if you used our trailing stop, you're out of that trade. You might have went short again here with pretty much a break even, and short again the third time at 19, and the price just went all the way down here. It fell 119 pips. And when the market goes underneath the lower containment band, usually you want to kind of watch it. What I typically do is move my stop down over the last 2 bars high. So let's say this is your stop at this point of the trade. Initially you put it over the highs of where you get short at. When it makes a lower low and goes sideways, you move it down. It goes lower again. I might have got stopped out right here. I probably would not have made these remaining 30 or 40 pips. And when it's this far underneath the lower band, I usually do not re-enter a trade when it breaks down, because there's less odds of a big move happening. But nonetheless, if I sold this when it broke these lows, or even if you shorted it when the trailing stop got hit at 20, or down here at 14, out of this trade here at around 40. So that's a beautiful 60 to 70 pip trade, predicted with the currency meter. Here's the pound dollar, and if you're looking at this one also broke a fib area, kind of went sideways right here. Didn't really have much of a pullback. I look for at least a 15 pip pullback. It's got the previous week's low there as a resistance, so I'd be looking for it to break down underneath the low. And I might have gone short right here and would have lost 10 pips on that. And later on, when it broke down again here at 92, got out here at 60. So if you lose 10 pips on one trade and then make 30 pips on the next one, guess what? You netted 20 pips. You're never going to have 100% winning trades, and very few days we even have a 70-80% wins. But some days when the market just keeps trending and trending, it's very hard not to have very high winning percentage. But other days, the market chops around before it finally makes its move. I mean, that's just the way the markets work. One of our trading methods is the Elliott two-wave system, and whenever you see a super weak currency like this and then it makes a pullback, you draw your fibs on this, and you want to get short somewhere between the first and second fib target. When it went up to this area right here, it didn't have that much strength. It wasn't even at the 80 level. So I would have gone short right here, somewhere at the previous week's low, major resistance area with my stop, maybe 10 pips up, and it went down a little bit. I usually move my stop down a little bit, and I would have got stopped out of this with a 4 or 5 pip loss, and then I would have re-entered it again here at 97. Market came down, and as you notice, it doesn't look that weak. So you never know what's going to happen in the future. I would have moved my stop right above these bars high and probably only made 4 or 5 pips there. And later on, when it broke down again, I would have shorted again at 78, and you can see it just kept falling and falling and falling. Most of the time, I'm not going to get greedy. I'm going to draw my fibs on the last big move, and I'm going to exit somewhere. It came down to the first fib target and went sideways, so I would have exited half my trade there. That's just the way I like to trade. And then the trailing stop on the second half, which would have got hit somewhere on this bar right here because it just flipped on the next bar. So it's hard to say where it would be. I'll just be conservative and say the second half was at 90. So we're out of the first half at 20, the other half at 90. That means our average exit was 105, 57.05, and we're short this thing somewhere around here. So it was almost a 70 pip move. One nice trade can really get rid of a ton of small losses and break evens, and a lot of your trades are going to be small 3 to 20 pip wins, and then you're going to occasionally get more and bigger wins like this one.